A rental property can look profitable because the rent is high, but rent alone does not tell the truth. Rental yield compares income with the property's cost. It helps investors see whether the property is actually producing enough return. Gross rental yield is the annual rent divided by the property price. If a home costs $300,000 and brings in $24,000 a year, the gross yield is 8%. That number is simple, but incomplete. Gross yield can make the surface story look simpler than the real situation. Net rental yield is more useful because it subtracts expenses. Property taxes, insurance, repairs, management fees, vacancy, service charges, WA fees, and maintenance can reduce the real return sharply. Net yield is often the detail that separates a quick reaction from a wiser response. A property with high rent can still have weak yield if the purchase price is too high. A cheaper property with modest rent can sometimes produce a better return. Yield is about the relationship between income and cost. Vacancy loss shapes what should be checked next. Location affects yield in different ways. Expensive prime areas may have lower yields but stronger resale demand. Less expensive areas may offer higher yields but more vacancy risk or slower price growth. Repair reserves turns the idea into something practical rather than only theoretical. Vacancy is one of the biggest hidden factors. A property rented for 11 months does not earn the same as one rented for 12. If it takes 2 months to find a tenant, the annual yield changes immediately. Financing and cash flow deserves attention before the choice becomes harder to reverse. Repairs also change the calculation. A broken air conditioner, roof repair, appliance replacement, or plumbing issue can erase several months of profit. Investors who ignore maintenance often overestimate yield. Cash-on-cash return can quietly move the cost from the present moment into the future. Financing matters because the mortgage payment affects cash flow. Yield may be calculated on property value, but the investor still needs to know whether rent covers loan payments, taxes, insurance, and reserves. Short-term rental costs helps explain why the obvious answer may not be the best answer. Cash-on-cash return is related but different. It compares annual cash return with the cash actually invested, such as down payment and closing costs. A leveraged property can show a different cash return than its simple rental yield. Tenant quality gives the situation its real-world weight. Short-term rentals may show attractive gross income, but their expenses are different. Cleaning, furnishing, platform fees, regulation, seasonality, and management can reduce the return. High nightly rates do not automatically mean high net yield. Tax treatment is worth checking when the first explanation feels too neat. Tenant quality affects yield too. A slightly lower rent from a reliable long-term tenant can outperform a higher rent with frequent turnover, late payments, or damage. Risk-adjusted return can decide whether the problem stays small or grows into a pattern. Taxes can change the final picture. Rental income, deductions, depreciation rules, and capital gains treatment vary by location. Investors should not rely on headline yield without understanding the tax side. Comparable rents keeps the analysis tied to behavior, money, timing, risk, or trust. Yield also needs to be compared with risk. A 10% yield in an unstable area is not automatically better than a 5% yield in a highly liquid area. The investor is being paid for risk, work, and uncertainty. Future capital expenses belongs in the decision because it changes what action would help. A common mistake is using the listing agent's rent estimate without checking real comparable rents. Asking rent is not the same as achieved rent. Actual leases nearby give a better picture. Appreciation versus income becomes more reliable when it appears more than once. Another mistake is ignoring future capital expenses. A building may need roof work, elevator repairs, exterior painting, or major system upgrades. Those costs may not appear every year, but they still belong in the investment calculation. Conservative assumptions should be checked before accepting the most comfortable explanation. Rental yield is useful for comparing properties, but it should not be the only metric. Appreciation potential, tenant demand, liquidity, legal rules, and financing terms all shape the investment. High rent and high price needs to be connected with the actual consequence. For a first-time investor, a simple test is to calculate rent after conservative expenses and vacancy. If the deal only works with perfect rent, perfect tenants, and no repairs, the yield is weaker than it looks. Location trade-offs keeps the topic grounded in daily life. For experienced investors, yield becomes a filter. It helps remove emotional attraction to nice finishes and forces attention back to income, cost, and risk. Management fees can be found in behavior, documents, timing, or repeated choices. Rental yield matters because real estate can hide poor returns behind big numbers. A high rent figure feels impressive until expenses and purchase price are placed beside it. Yield as a filter makes the issue easier to name in plain words. The useful takeaway is to read rental yield as a starting point, not a final verdict. A good rental property should make sense after expenses, vacancy, financing, and realistic maintenance are included. That is why experienced investors usually keep a repair reserve instead of treating every rent payment as spendable profit. Rental yield is only a starting point. A high-yield property can still disappoint if repairs are constant, tenants leave often, or the area has weak long-term demand. The percentage may look clean, but ownership is lived month by month. Gross yield and net yield should not be confused. Gross yield uses rent against property price, so it is quick and easy. Net yield is harder because it subtracts costs such as management fees, repairs, insurance, taxes, service charges, vacancy, and sometimes financing. Investors who stop at gross yield may think a property is stronger than it really is. Vacancy changes the picture quickly. A property rented for 12 months produces a different result from one that sits empty for 2 months every year. Investors who ignore vacancy often overestimate income before the first tenant even moves in. The yield also has to fit the investor's goal. Someone who wants monthly income may care more about stable rent and low vacancy. Someone aiming for long-term appreciation may accept lower yield if the area has strong growth potential. The same property can look different depending on the strategy. Yield also has to be compared with risk. A stable area with modest yield may be safer than a high-yield area with weak tenants, poor maintenance, or uncertain resale value. The higher number is not automatically the better investment. This is why experienced investors often stress test the numbers. They may ask what happens if rent drops, a tenant leaves, interest rates rise, or a repair arrives in the first month. A yield that survives those questions is more meaningful than one that works only in a perfect spreadsheet. Rental yield helps investors ask better questions. How much rent can the property realistically earn? What costs reduce that income? How often might it sit empty? Once those answers are included, yield becomes a useful tool instead of a tempting headline number.